880 were returned to the business. Goods valued for 20,880 were returned to the business by a credit customer, and a credit note issued immediately. And a credit note issued immediately. And you're being told, and the credit note issued immediately. What is that? And does it affect input or output? What is that? It affects output. How does it affect output? T and Mary, how does it affect the output? How does it affect the output? How does it affect what we call the output? It reduces what we call the output. So then we're being told next, that is September 12th, paid for catering expenses, and you're being told that shillings 26,860. Paid for catering expenses, that is shillings 20,880. 680, sorry, in respect to a restaurant facility managed by another firm. So what did you say about catering services? Those are non-deductible input fee, non-deductible input VAT. So then we move to the next, we're being told that sold goods, that is September 14th, we're being told that sold goods to a firm operating in Egypt. Sold goods to a firm operating in Egypt for shillings 480. Sold goods to firm that is operating in Egypt for shillings 480. For shillings 480. What is that? So that is an export. Exports are zero rated. So remember that is an export, and exports are zero rated. So that is an export, and we understand that that export is zero rated. So then you move to the next. We're being told that received what we call a debit note of 62,640 in respect to erroneous invoice received earlier. So being told that pay received a debit note for shilling 62,640 in respect to erroneous invoice received earlier. So what is that? And what does it affect? That is a debit note received. And it affects what? Input, which is purchases. The examiner tells us September 18, exported goods to Malawi. Exported goods to Malawi. We have exported goods to Malawi, valued at shillings 240. When you say exported goods to Malawi, valued at shillings 240, how do you treat it? Valued at shillings 240. That is an export, and that is zero rated. So the next, that is September 20th, the examiner tells us that purchased computers and computer softwares for shillings 208,800 for use in business. For shillings 208,800 for use in business. How do you do that? That is an input. Input, for those who are not in class, input is VAT on purchases and expenses. So then the next we say supplied and processed. Supplied what we call and processed fruits and milk to Starlight Enterprise for shillings 170. So being told that the supplied what we call and processed fruits and milk to Starlight Enterprise for shillings 170. What is that? Remember that is sales, but that sales is exempt. That is exempt. That, remember that is exempt. Together. Remember that is exempt. So then the examiner tells us that is September 24th, sold goods to Lucky Enterprise. You're being told sold goods to Lucky Enterprise for shillings 64,960. for shilling 64,960. For shilling 64,960. What is that? Sold goods to Lucky Enterprise for shillings 64,960. Aziz, how do you treat that? Aziz and Ann and FJ, how do you treat that? For shillings, how do you treat that? That is an output. That is output. Thank you. So then you're being told that purchased oil and fuel. You're told that purchased oil and fuel of shillings 9,280, of shillings 9,280 for a generator used in business. For a generator, we say used in business. For a generator that was used in business. How do you treat that? For a generator that was used in business. So that is input. At what rate? Remember, as of 30th, that is June 2023, oil and fuel changed from 8 to 16 to 16 at the rate of 16. I'm saying as of 30th, are we together? As of 30th, as of 30th, that is June 2023, oil changed from 8 to 16. Perfect. Thank you, Aziz. Noted that. They say a customer owing a business goods worth 20,300 was declared bankrupt and the bad debt was written off. And the bad debt was written off. How do you do that? And the bad debt was written off. And the bad debt was written off. What did you say about that? What did you say that? That basically reduces what's called the output. Output, that will reduce the output. Then lastly, we have what's called sold goods exempt from VAT. So being told that sold goods exempt from VAT for shillings 250,000. What is that? Sold goods exempt from VAT, shillings 250,000. That touches on output, but that is exempt. So then the examiner tells us all transactions, examiner tells us that all transactions are inclusive of value-added tax, that is VAT, where applicable, unless otherwise stated. So the end of that. Then required, before we go to required, is there anybody with a question? Is there anybody with a question? Is there anybody with a question? Kuna mtu ana swali. Is there anybody with a question? Mwalimu, if the question, June 20? As this says, let me. For tax, this is real time. When changes are effected, what you do is real time altogether. If it's a day before 30th, then that should be 8%. Otherwise, from 30th, that is July, that should be 16%, 16% altogether. As per day. So anything less than 30th, that should be 8%, 8% together. 8%, 8%, 8%, 8%. And I want you to also note that tax changes a lot. Have you noted that tax changes a lot? What we're learning today, the number of things that will not apply. What you're learning today in the next 2 years will have different rates, or there will be a lot of changes altogether. For tax, it changes a lot. We can have something in operation, somebody goes to court, and the next day it doesn't exist. Have you ever noted that? We are applying something, and the next day it no longer exists. Is it true for tax? That is tax for you. Things will keep on changing. Believe me, what you're learning today, there will be changes to it. Is it true as is and the rest of the team? Perfect, if that is true. So then we move to the next, we told calculate the value added tax, calculate the value added tax payable or refundable. Calculate the value added tax payable or refundable to 𝐻𝐂𝐒 PLC for the month of September. For the month of September. We did say that in questions where we have exempt, and we are not told that those exempt purchases that were sold were as exempt could not be traced. We are not told whether they could be traced. Which method did you say we are going to use in this particular question? Which method did you say we are going to use in this particular question? Are we going to use the direct method where we are going to restrict? So we proceed. We can start with the input for the start. We start with the input. We can start with input. So we start with the input. So we have item. We can have item. You can also include the date if you want. You have the date, the amount. Then you have the VAT rate. Then we have the VAT. So we start with the input for this question. We start with the input. So the first one on the input, we say purchases. We have purchase, local purchase. We can local purchase. What is the figure for the local purchase? The figure is 103 to 40. Which rate are we using? And why are we using that rate? Which rate are we using and why are we going to apply that rate? 16 over 116. Frida, I think you've forgotten 16 over 116. We are not getting self-exclusive. Yes, I'm increasing the fonts. Let me repeat it again. Let me just increase. Local. I hope now it's okay, my good brother. So 103 to 40. The rate is 16 over 116. And why are we using 16 over 116? 116 over 16 over 116? Why are we using that? So that others can also understand. Because we've been told all transactions are inclusive. All transactions are inclusive of value-added tax. So what do we have? All transactions are inclusive of value-added tax. So we have 14. That is 14 to 40. 14 to 40. Then we proceed to the next. We have what we call import. What is the value of import? The working that you did. The value for the import from the working, 425. What do you say about import? Imports are exclusive. So that's we use 16 over 100. Even if the question is inclusive, imports are normally exclusive. So what is the value of that? Provide that for me. 16 over 100, what do we have? So that should be 68. 68. Then we go to audit fee paid. We have next is audit fee. So for audit fee, we have a figure of 17,400. We have 16 over 116. So what is the VAT on audit fee? The VAT on audit fee. The VAT on audit fee. Meanwhile, as you make the entries, the scores you're getting, as you make right entries, you're scoring marks. So then we'll move to the next, go to catering. Catering is a non-deductible catering services. So this is non-deductible. This is non-deductible. That is non-deductible input VAT. So then we proceed to the next. We have debit not received. Debit not received. We have the debit not received. And the figure for the debit not received is 62,640. So that is 16 over 116. What is the VAT on debit not received? What is the debit not? Debit not received, the VAT on debit not received, we have it as 8640, 8640. Then we proceed to the next. We have computer and computer softwares. The next purchase or expense is computer and what you call computer softwares. And computer softwares. Computer and computer softwares, we have 208,800. So that should be 16 over 116. 16 over 116. So what is that? I'm going back there. 14th is output. Sheila, Lenovo, I'm on input. Input is purchases and expense. 14th, that should be on sales. Sawa. So we have 28. Somebody says 28,800. Together, 28,800. So then we proceed to the next. We have oil and fuel. We have oil and what's called fuel. Oil and fuel. We have 92,80. So times 16 over 116. So that is 12. We have it as 12,80. So then I hope there's no input. There's no input. So what is the total input? Total input. Total input VAT. So what is the total input VAT? What is the total input VAT? Check date 10. So that affects sales. Goods valued at 20. Good valued at 20,000 were returned to the business by credit customer. That affects the sales. Okay. The 10 that affects the sales, return inwards. That is return inwards. And the credit note was issued. Okay. Credit note issued affects sales. Remember, when you're doing the restriction, we separate input and output. Okay, are you sorted? If that is sorted, you respond with a yes. Okay, is that sorted? So that should be 123. We have 123, 360. Perfect. So then you go to the output. Before we do the restriction, we get the output VAT. Is there anything on input that we've not given? So we have everything on input. Is that correct? Everything on input is sorted. We respond with a yes if that is sorted. Perfect. So I go to the sales. We have the first one. We have the items. Can you see here? Items. We have amount. We have the VAT rate. And then we have the VAT. Are you able to see the board perfectly well at that point? I hope you can. So then we have what we call local sales. So the local sales, we had a figure of 180, 960, the VAT rate is 16 over 116. So what is that? The VAT rate is, so that should be 24. We have it as 24, 960. Perfect. So then we move to the next, you're being told the next is credit note issued. So we have what's called the credit note issued. So what we call the credit note issued on goods that were returned. So the credit note issued, that was 20,880 times 16 over 116, and that will less. So what do you have? That figure that you're lessing, What is the figure that we are lessing? The figure that we are lessing. Provide the figure that you're lessing. 2880. Is it right? What has been given? Which one is right? Is it Sheila or 28? That should be 2880. Then you have the next. The next is export. Export. We have it Egypt. Egypt. Export Egypt. That should be 480. So that is zero rated. So this should be zero. You must write a zero, not a dash. Zero and the dash are two different things. The dash means exempt. So we move to the next, we have what's called export Malawi. We have export, and we understand that goes to Malawi. So Malawi is 240. So we have 0. 240, then we have 0. Then we move to the next, we have what's called supply of unprocessed. So we have the unprocessed fruits and milk. Remember, these are exempt. These are exempt, the figure 170. Though there's no entry for this, but that is exempt. Everybody together with me? Are you together with me? If you're together with me, give me a yes. If we are together, then you give me a yes. Perfect if you're together. So then we proceed to the next. We have what's called Lucky Enterprise. We have what we call Lucky, another cell, Lucky Enterprise. So Lucky Enterprise, we have a figure of 69, 64, 960. And then we have a 16 over 116. What is that output VAT? What is the VAT for Lucky? Lucky, what is the figure? Lucky, we have 89. We have a figure of 8960. That is for Lucky. 8960 for Lucky. So then next we have, that was a customer owing the business goods worth 20,300 was declared bankrupt, and the debt was immediately written off. How did you do that? What did you say? We said bad debt. That should be bad debt. So we have the budget, 20,300, 16 over 116. So what do you have? So what is the figure for that? It is 2,800. So say 2,800. So then we have lastly, so there's no marking for that. We have what we call exempt sales. So exempt sales, we head to 50. We have a dash and dash. So then we have what we call total output VAT. What is the total output VAT? What is the total output VAT? Give me the total output VAT. So give me what I call the total output VAT. So somebody has it as 28 to 40. So the marking point is the entries, those entries. The marking point should be the entries. So in this case, we said that we restrict because we cannot track, we cannot basically track sales. We cannot track purchases that were sold as exempt. So we do what? We restrict altogether. We basically restrict altogether. We basically restrict altogether. So when you're restricting, we're saying taxable supplies, over what you call the total supplies, times what they call them the total input VAT, times the total input VAT, times the total input VAT. Allow me to adjust the camera. Allow me to adjust our camera. So that should be okay. So we're saying when we're restricting, number one, when restricting, taxable supply, we understand is zero rate, 0 plus standard rate. Are we together? When you talk about taxable supply, total supplies, that is standard rate plus the 0 rate plus what you call exempt. Is that noted at the back of our mind? When you talk about taxable supplies, that is the 0 rate plus the standard rate. And when you talk about the total supplies, that should be the standard rate plus 0 rate plus exempt. Together, team. If you're together, we respond with yes. Kindly give me yes if you're together. While we're doing this, as an NP, while we're doing this, we are basically saying that the standard rate cells, we're saying that the standard rate cells, we say should be exclusive. It should be exclusive of what we call VAT. While you're doing that, we're saying that the standard rate cells should basically be exclusive of what we call VAT. While we're doing that, we're basically saying that the standard rate cells should basically be exclusive of VAT. Are they exclusive of VAT when you talk about the standard rate cells? Is it exclusive of VAT? Is it exclusive of VAT? No. So where the standard rate cells? Local cells, this is standard rate at 16, standard rate. Another standard rate cells, Nigapi, we have it here, standard rate altogether. So it's affected by credit note and it's affected by bad debt. So what is the total standard rate cells? So the total standard rate cells should be a figure of 189.60 plus a figure of what you have as 64.960. What is the total standard rate cells? What is the total standard rate cells when you add those two? When you add those two, what is the total standard rate cells? When you add those two, what is the total standard rate cells? What is the total standard rate cells? What should be the total standard rate cells? Total standard rate cells. So that we have it as 245. Somebody gets me 245,920. 245,920. And we adjust it. We adjust this figure, 245,920. We adjust by lessing the credit note, which is 20,880. We adjust it by lessing 2,300. So when you adjust this, what is the net figure? So what should be the net figure when you adjust those two? When we adjust those two, what should be the figure? When you adjust those two, what is the figure? When you adjust that, what is the figure? So we have 204, 204,820. And somebody just to confirm that. Somebody to confirm what T has done and what, somebody to confirm what T has done. Which is which? Is it 740? 740. So that should be, we have it as 740. So we're basically saying that this figure, 204,740, is basically 116% because that's inclusive. Yes, equals to 116. What about the figure exclusive of VAT, which is 100%? So 100% would be 100 over 116 times 204,740. So what is the figure exclusive of VAT? The figure exclusive of VAT equals to that. So what is that figure? So we have 176. We have a figure of 176,500. So we can get the taxable supplies. So taxable supplies should be the standard rate, which we have 176. Zero rate nigani nagani. Remember, this is zero rate. So we have for 80,000. And the next zero rate is 240. So this is zero rate. Zero rate. This is also zero rate. So what is the total taxable supply? 240. Taxable supplies. What is the figure for the taxable supplies? The figure for the taxable supply. Give me the figure for the taxable supply. Yes, plus this. What do you have? Plus that, what do you have? So that is, we have a figure of 896,500. Can I wrap this part in the middle? The input? Can I wrap the input? Perfect. So then we get the total supplies. We get the total supplies. So we get the total supplies. So we understand that the total supplies, we get the total supplies. Total supplies should now be standard rate, 0 and exempt. So standard rate, we know is 176,500 plus 720 plus 720. Exempt, which is exempt? When you pick that question, exempt is which figure? Plus exempt. Exempt, we have 250. But you also have plus 170. So what is the total taxable supply? 250 plus 170. So what is the total supplies? What is called the total supplies? So what is the figure for the total supplies? So we have it as 13,16,500. So we can restrict. We get it now what's called deductible. Deductible or restricted input VAT. Input VAT. So where we say the taxable supply, which is 896,500 over 1,316,500 times. What is the total input VAT that we wrapped here? What is the total input VAT that we wrapped? Total input VAT. Give me the total input VAT. So that is 123,360. So what is the deductible? Give me the deductible input VAT. Get me the deductible. T, zero rated for 80 plus 240. T for 80 plus 240, that is 720. For 80 plus 240, T for 80 plus zero rated for 80 plus 240. T, where does 720 come from? The first zero rated to Egypt was for 80, then 240 to Malawi. So that's where we get 720. So what are we getting as deductible input VAT? Are we getting 84? Are we getting that? 84? Perfect. So then we get the VAT payable, so what we call refundable. So we have output is 28 to 40. minus 84,005. So this is VAT refund. VAT refund. What is the refund? What is the VAT refund? What is the VAT refund? Get me the VAT refund. So the refund should be 55,765. But the key thing is not even the answers, the procedure. So how many marks was that question? How many marks was that particular question? 10. How many entries did you have on those input? Input plus that? 1, 2, 3, 4, 5. Input tulikuwa na ngapi? Yes. Input we had about 7. So any 10 times 1, that should give us the answer. Any 10 times 1. So do you see that this question is doable? Is this question doable? Yes. I want to pick a small question that will be able to do this because I want to discuss. I want particularly to discuss that, and then we go to the tax investigation. I want to try and discuss the remaining part. But I want to give a small question before we go to discussing what is remaining in the handout. Together, team. I want to do a small question. I think we should be able to do that question. Can we? Who has a question? Nani and Aswali. So we can pick on a small question. Then we discuss the handout. That's a smaller question. We discuss the handout. We'll pick a smaller question. We'll pick a smaller question. Some of the small questions. So check for me which number. August 22. I know it's a smaller question. August Ambucher, are you in class today? Gilbert, are you in class? So August, check a question in August. That is August 22. And tell me which number is that? August 22. I know it's a smaller question. We do that smaller question as the third. That smaller question as the third. As the third. That smaller question as the third. So which number is the particular question? Question 4B. So all of us to open that question. All of us to open that question. Are we there, all of us? As Walimu is opening his question. Are we there? Perfect. So we can do that. So we have it there. So we're being told that Zawadi has a sheet. Is this Zawadi has a sheet? Zawadi has a sheet. Is it that? Is it that? So being told that Zawadi has a sheet provides what we call consultancy. Zawadi has a sheet provides what we call consultancy services. Provide what we call consultancy services to various clients whose terms of contract allow clients to pay for services either before or after provision of service. Before or after provision of service. The following information is provided regarding firm's transaction for the month of October, regarding what we call the firm's transaction for the month of October, November, and December. So number one is audit for XL supermarket. So the value of service is basically value of service is 700,000, and the service provision date is 20. Service provision date is 25th October 2021. Then the payment date should be 5th November 2021. Are we able to see that? That is perfect. So then the next thing to the training to Kyle Security. The figure is 3rd November 2021, and you say not yet paid. Not yet paid. 3rd November, and you're being told not yet paid. Not yet paid. So then we have next is accountancy. Accountancy. We have what we call Watoto. We have what we call Watoto. We have what we call Watoto. Accountancy for Watoto Children's Home. The figure is 600,000. The figure is 600,000. That is for December. That was provision date is provision date. That is 5th December 2021. And payment date was 20th November 2021. Is that noted? Is that noted? So what do you think this question wants to test on learners? What do you think this question wants to test on you? Because when I look at that information, what is this question trying to test? Which concept does it want to test when you look at this particular question? The concept of the tax form, as is you have it. It basically wants to test the concept of the tax point altogether. So tax point is basically, for tax point, is basically as is. When is the tax point? When is the tax point? When services are rendered, or payment is done only, or payment is done partially or only. That should be the tax point altogether. So the next we have debt collection services to Zuela. The figure is 820. That is 9th November, and payment is done. And payment is done. Yes, the earlier when the invoice is issued or payment is done. Perfect. So debt collection to services to Zuela, the figure is 820. That was the service provision was 9th of November, and payment date is 30th September. I hope you mark those dates. So then we have strategic planning. Strategic planning. We have development. Strategic plan development. Basel. The figure is 2,115,000. The service date is 10th November 2021, and you're told not yet paid. So then you're being told that management consultancy. Look at the management consultancy. Shylock investment. The figure is 1,440,000. The service provision date is 13th November 2021. 40% was paid on 13th November. 40% of that amount was basically paid on 13th November 2021. Then you have what we call internal review. Next is what we call the internal review. Internal control review, Lema Limited. The figure is 960. The service provision date is 18th November 2021. So 10% paid on October. 10% was actually paid on October. 10% was actually paid on October. 10% was basically paid on October 7th, 2021. Then you have the next, what they call financial consultancy to W Limited. Financial consultancy to W Limited. The figure is 1.2 million. The service provision date is 20th. The service provision date is 20th November. The payment was done on 1st December 2021 together. Up to that point, are we together? I just want you to mark those dates. Just mark those dates. The key thing is just to mark those dates. So then the next we're being told that 𝐓𝐿𝐿oc investment. We're being told 𝐓𝐿𝐿oc investment. 𝐓𝐿𝐿oc investment. We say it was declared bankrupt. 𝐓𝐿𝐿oc investment was declared bankrupt on 30th November 2021. If 𝐓𝐿𝐿oc investment was declared bankrupt on 30th November 2021,
so
what happens to
I
𝐓𝐿𝐿oc?
start on this new topic, which is basically
If it was declared, remember they're not paid fully, but they paid partially. So what happens if it's declared bankrupt by 30th?
A number of issues.
What happens if it's declared bankrupt?
We are going to define what
happens? That becomes what's called a bad debt. That becomes a bad debt.
And the recognition criteria for financial instruments.
So then you're being told that on
something called
November 2021,
then
the word which is renewed, it's National Industrial Training License of 30, National Industrial Training License of 30,000, and paid a legal fee.
And the examples,
of 360,
initial and also subsequent measurement of financial assets, financial abilities, and then also we're going to discuss something to do with impairment of financial assets. And finally, as far as the topic is concerned, we are going to discuss on something called hedging in relation to financial good instruments. So those are basically a number of issues we're going to discuss in relation to this topic. But generally, we have to start by defining what are the financial instruments. Financial instruments generally, these are those particular securities which are issued by companies to raise capital, which is required maybe to undertake various projects. And good examples of financial instruments include things like shares, include things like debentures, include things like what we refer as the own stock, and also both. Those are good examples of the financial instrument. But how do we define financial instrument in accordance with IFRS 9? Financial instrument is actually defined to be a contract which is entered into between two entities, e.g. Company A and Company B, and that contract gives rise to financial asset, one of the company, and a financial liability or equity to the other entity. So therefore, that is basically the definition of a financial instrument. So we say it is a contract. It is a contract which gives rise to a financial asset to one entity, and a financial liability, or basically equity to the other entity, So that is how we define a financial instrument. Is that contract which will give rise to financial asset as far as one entity is concerned, a financial liability or equity to another entity. For us to be able to understand this particular definition, let's look on a small example here, whereby maybe we assume we have a company here, say Company X, and this company want to raise capital. There are a number of ways in terms of how this company can raise capital. It can issue shares, it can issue debentures, it can issue the board then, and so on. And therefore, we assume that this company will issue, for example, ordinary shares, or this particular company can issue what? Debentures. And we also assume that some of the shares or debentures issued by company X, some of them have been issued to company Y. So therefore, in this case, we say that these two companies here have entered into a contract for the issue of shares, or basically for the issue of debentures. Now, this contract itself is this particular contract is what is actually referred to as a financial instrument, because this contract for the issue of shares, this contract for the issue of debentures, it basically gives rise to financial asset as far as one company is concerned here, a financial ability or equity to one of the company. Like generally, we assume that this company here has issued shares. So what we know is that once a company issues shares, then it releases a capital which is known as ordinary share capital. So from what we know is that ordinary share capital is part of equity. So therefore, you can see once this company issue ordinary shares, then that gives rise to equity as far as company X is concerned. On the other hand, we assume that this company here, instead of issuing shares, it has issued debentures. So once a company issued debentures, this is something generally we know. That company, then we say it has entered into a contract, and that contract for the issue of debentures requires this company to pay interest. It must pay interest on these debentures which have been issued. And once the debentures mature, they must be redeemed. So during the redemption, then the company will have to pay the principal amount. So therefore, once a company has issued debentures, then this gives rise to a financial, or basically this gives rise to an obligation to pay cash, of which in this case the cash which is paid is in form of interest, which is basically payable on an annual basis, and also the principal amount, which is the amount which is supposed to be paid whenever the debentures have matured and they're being redeemed. So therefore, this obligation to pay cash, basically this is a liability. Or in other terms, specifically, we refer to this as a financial liability. So therefore, once a company has issued debentures, then we say that that is a form of a liability, but specifically, we refer to that as a financial liability. So therefore, you can see that once this company issues shares, then it has entered into a contract which will give rise to equity. Once our company has issued debentures, this company enter into a contract which gives rise to a financial liability, simply because you're saying this company has an obligation to do what? To pay interest, and also to pay what? The principal amount. Now, on the other hand, this company which now will buy, or which will invest in shares or debentures issued by this company we say has invested. This company has actually invested. It has invested in what? It has invested in shares. It has invested in debentures issued by company X. Any form of investment in shares, any form of investment in debt instrument like treasury bills, treasury bonds, is basically an asset. If you have made an investment in shares, you have made an investment in debt instrument, is an asset, but specifically, we refer to that as a financial asset. We refer to that as a financial asset. So you can see that this company here, once it invests in shares, once it invests in what? It invests in shares, it invests in debentures, which are issued by this particular company here, then this gives rise now to what? To a financial asset. And therefore, this particular contract here, you can see it basically it actually meets, or actually this particular contract here, you can see that it meets that particular definition of what? It meets that definition of IFRS what? IFRS 9. So therefore, a financial instrument, we say, is a contract which gives rise to financial assets to one of the entity, a financial liability or equity to the other entity. And actually, we are saying a good example of a financial instrument is a contract for the issue of shares, is a contract for the issue of debentures, things like both, things like own stock and so on. Then from there, we can look on another aspect as far as IFRS 9 is concerned. And I want us to look on something called the recognition of financial instrument. recognition of financial instruments. So in this case, what do you mean by a financial instrument? What do you mean by recognition? That is recognition of financial instruments. So recognition generally is the process through which an entity will record either an asset or basically a liability in its books of account, and subsequently the company recognize it in the statement of financial position, which will be prepared at the end of what? At the end of the year. So therefore, a question arises here: when should, for example, these two companies recognize these particular shares or debentures which have been issued, or basically which now this company has invested in its books of accounts? So according to IFRS 9, financial instruments should be recognized when a company here, or when an entity here becomes a party to this contract, And actually a company, or these two entities, will become a party to this contract once this company issues the shares or debentures, not when the company receive money for those shares or debentures which have been issued. Once the shares or the debentures have been issued, the company is said to have entered into that contract. And once this company buy the shares, or it invests in shares or debentures, it has entered into that word contract. You should go ahead, according to IFRS 9, and recognize that those particular shares or debentures in its books of what? Of account. So therefore, financial instruments here are recognized when an entity becomes a party to a contractual relationship. So once an entity has become a party to this particular contract, it should go ahead and basically recognize those particular financial instruments Therefore, the directors of that company maybe decide to sell one of the assets which is owned by that company, but because the asset is still used by the company, the asset will have to be leased immediately afterwards, after the sale. So therefore, in case of a sales leaseback transaction, we say, and this whereby in terms of how we compute this, there is a right word and difference. So the formula which we use to compute this here, we take the previous carrying amount, or basically the previous net book value. So this is the net book value, or the carrying amount of the asset before it was disposed. This particular asset which was sold, what was its net book value, or what was its carrying amount? So we multiply this with we multiply this with the fair value, we multiply this with the present value of the lease payment, divided that with the fair value. Divided that with what? The fair value. Remember, in this case, we have said the fair value is the same with the sales proceed. Is the same with the sales what? Proceed. So this is basically the other formula, which basically you also need to understand. Very, very important. Those two formulas. That formula for computing the gain on disposal, and this formula for computing the right of use asset, they are very, very important. I've said to compute the right of use asset, we take the previous carrying amount of the net book value of the asset, we multiply that with the present value of the lease payment, we divide that with the fair value or the sales what? Proceed. So therefore, in case this particular transaction is a true sale, it basically meets these two criteria specified under IFRS 15. Then you're saying that this particular company will do those four things. One, they recognize the asset. Number two, recognize the gain or loss on disposal, which is computed using that formula. And then number three, recognize the right of use asset, which is computed using that formula. And number four, recognize the lease liability, which basically we compute in the normal way, as the present value of the minimum lease payment, or as the present value of the lease of the lease payment. So this basically what is very, very important as far as this is concerned. So then let's move and look on how this company here, that is the buyer 𝐍𝐿, should basically account for this transaction if it is a true sale. If it is a true what? A true sale. So if it is a true sale, so how should this company account for this transaction? So if it is a true sale, it basically means that this company here, number one, should recognize the asset. This company should do what? Recognize the asset in its statement of financial position. That's why we are saying this company here will have to recognize. This company recognize, remove that asset, because the control, the reward and the risk have been transferred to this company. And then this company, we are saying number one, would basically recognize that asset. We know whenever a company has bought an asset, how should that company recognize that asset? Basically debit the asset account and then credit the bank or cash account. So number two, this company then will proceed and account for this risk, account for the risk as either account for the risk as either